Hi everyone, Gavin McMaster here from Options Trading IQ. Just wanted to talk briefly today about a trading strategy I've been using recently called credit spreads. I've done probably about 8 or 9 of these trades recently, and in fact only one of them has been a losing trade, and that one was basically break even. I lost maybe a couple of cents on each contract. The idea is that if we look here, this is CLF that we're looking at here on this chart, Cliff Resources. Now, with this one, we can see here there's been some pretty heavy selling over the last couple of days on big volume. So what that indicates is big institutions closing out their positions, getting rid of their long positions. So you generally want to be following the smart money, the institutional money. So if they're getting out of the stock, it's probably a good time to not be long, and maybe not necessarily get short, but you probably don't want to be long. And you can see here it's also crossed under the 50-day moving average. It bounced up quite nicely on Friday, but it's still below that 50-day moving average. Stochastics is maybe starting to look a little oversold, but MACD is really heading downwards, and just generally the chart just kind of looks a bit broken. It had been pretty consistently above this 50-day moving average. Now it's had some big selling and it's below that 50-day average, and the average is sort of starting to level off, and maybe we'll see it come down a little bit. So the strategy that we can use here is we can sell a credit spread above the market so that we have a bit of margin for error with our trade. So let's just take a look at the options chains that are available. So credit spreads are a net selling position in options. So you generally want to be short-dated options that you're looking at. So we'll use April. And we'll just look at these 3 strike prices here just above the money. And we want to be looking at calls. So we'll add those in. Okay, so we can see that the $90 call's trading around 425, the 95's at 250, and the 100 is at 139. So basically the idea here is that we would, depending on how aggressive you wanted to be with the strategy, you could sell the $90 call and buy the $95 call. Or if you're a little bit more conservative and you wanted a bit more margin for error but a lower profit potential, you could sell the $95 call and buy the $100 call. So if we look at these examples, I've got a spreadsheet set up that will basically analyze the credit spreads for us. So we're looking at 425 and 430. So what we do here is put in the bid, and it'll just give us the mid price there. And the 95 calls 251, 255. And the strike prices here were 90 and 95, and the current price is around 87.50. Okay, so I've done it in the wrong one here. It should have been in the call spread one. Okay, so this kind of gives us an indication of what we should put the spread on for. Depending on how many contracts you want to sell, say we'd look at, if you've got a small account, you'd look at maybe 5 contracts. Your maximum gain on the trade is $872, and your maximum loss is $1,600, which is basically, this is the total amount of capital at risk. This is just taking the difference in the strike prices less the premium that you're receiving. So which is basically a 53% return on your capital at risk. Or let's say we wanted to be a bit more conservative and use the 95 and 100 strikes, which is going to be 251, so 139, 144. Okay, so you're looking at $1.11 per contract, which is a maximum gain of 557, maximum loss of 1900, about a 28% return on your capital at risk. So let's say we want to take the conservative route. we could just enter. I'm not sure if this is going to let us do it after hours, but if you go, no, it doesn't look like it's going to let us do it. But you can basically, in the Interactive Brokers Trader Workstation, is you can, instead of buying the 95 and selling the 90 as separate trades, you can basically just enter as one trade, and this analysis here kind of gives you a good idea of what the rough price should be. So this credit spread here is going to profit if CLF stays below $95. You're going to keep this whole premium. So you can see here up to 95 is your sort of your break even on this trade. So you've got a quite good margin for error there. Okay, so what if we wanted to take the other side of the market? What if we thought, okay, this is a great stock, it's had a bit of a sell-off, it's had another up day here, so maybe it's going to recover and go up. Say we were kind of neutral to bullish on the stock, maybe we wanted to sell a put spread below the market, we didn't think it's going to fall below, say, 80. We could look at that as well. Okay, so let's say we want to sell the 80 and buy the 75. So that's 239, 244, and 130, 135. Maybe I've done that the wrong way around. I think that was right. Yep. Okay, so if you're bullish on the stock or don't think the stock's going to fall below 80, which from sort of 87.50, that's almost a 10% drop. So you've got quite a good margin for error there. Oh, one other thing to mention here, this is your kind of break-even point. So you've got basically an 8.5% drop before you start to lose money on this trade. So here we're looking at, let's say we just want to stick with the 5 contracts. Here we're looking at a $545 return and a $1,900 loss, a 27% return. The other option with this trading strategy is you could kind of look to corner the market. You could do both trades, which is what's known as an iron condor. You could sell the 80 and 75 put spread and also sell the 95 $100 put spread, call spread, sorry. So you would basically profit if the market stays between 90 and 80. So if it stays in this massive range here, it's fairly likely that that's going to happen over the course of the next month. We've had a bit of volatility here, but you may see some kind of sideways consolidation here for a week or two. So if you wanted to do that trade, you'd put on the put spread, and you'd also put on this call spread, and you're looking at making $1,100 basically. So that could be quite a good option for some traders out there. I guess this would probably be a good time to remind you that this is not any sort of financial advice that I'm giving here. I'm not recommending any of these trades. I'm just sort of providing this information for illustrative purposes to, give you an idea of some of the trading strategies that I'm using and that are working quite well for me, and sort of how I analyze the market. We can look at another example. Say we were neutral to bullish on the Nasdaq. We could do a similar trade. We could do a put spread on the Nasdaq. I tend to not do a lot of spreads on individual stocks just because of the volatility is a lot higher, or can be. So we could look at something on the Nasdaq. Let's just see where the chart's at. Okay, so again, this chart does look a little bit broken, but say we were sort of neutral to bullish on the index, so we didn't think it's going to fall too much further. We could look at writing a put spread sort of around 2,200. Depending on how conservative we wanted to be, maybe we could even look to go further out of the market. So let's just sort of see what the option chains look like. Okay, so we're getting some really good premium there by the look of it for those options. So maybe we would look at the 2100 and the 2050 put spread. So let's get the current price around 2300. And we want to be using 2050 and 2100. So we're giving ourselves again about an 8.7% margin for error. And you know, we've got sort of 4 weeks, I think, till the April expiry, because it's April 14th. So you know, you're not often going to see the market fall 8.7% in a month. It does happen, and you need to have really good stop losses in place with this strategy. But generally, you're not going to see a market move that severe in a month. One thing I tend to do is I have a stop loss order on my sold position, and I leave the bought position open. That way, if we experience some massive volatility, say like a flash crash that we had last year where the market dropped 10% in half an hour, you'd be stopped out on this short position, but your long put would still be open, and you'd be making money on this one all the way down, and you've already closed this one out, so you wouldn't have to worry about it. So that's kind of one thing to think about. So 2050 is 829.40. And 1190 1340. I guess another thing to consider here is that this spread is really quite wide, so you're probably not going to get the ideal execution price of 385. Maybe you're going to get 350 or something like that. So you've got to be a bit conservative when you're looking at this stuff sometimes, especially when the spread's quite as large as that. But this one, you're looking, this is quite a large loss you're looking at, so maybe you want to be more conservative, just sell a couple of contracts. You're making 770 on a maximum capital at risk of 9,200, which is an 8% return in a month, which isn't bad. But you do have to be careful with this strategy on the loss side, because you are a net seller of options. It is a risky strategy, and it's not for everyone. But like I said, if you have your stop losses in place and you have a trading plan that you're following, and you know how you're going to handle these trades if things go wrong, then that's really crucial. You need to really have that trading plan in place before you enter this strategy, and definitely paper trade this strategy before you try it live, because you wouldn't want to have your first month with your options trading account and something goes wrong, there's a flash crash or whatever, and you're sitting on even a $7,000-8,000 loss or something. You really wouldn't want that. So definitely paper trade first. But you can see the potential here for profit. You've got a massive margin for error. You're collecting this fairly big premium every month, which is a really large percentage on your maximum capital at risk. So anyway, there you go. There's a bit of information on a strategy that's been working really, really well for me lately. I hope it's been helpful to you. And yes, thanks for listening in, and enjoy your trading. I hope you have a good month.